If you see more hype or fear than substance, that's a true contrarian signal. By blending awareness of sentiment with your own fundamental research, you develop a nuanced view. You don't get sucked in by the crowd, but you don't ignore valuable market signals either. This helps you avoid jumping in blindly and also allows you to catch wind of any positive shift before others fully notice. The result? Better timing, fewer nasty surprises, and a smoother path for your contrarian plays to shine. Contrarian investing is ideally a rational research based process, but emotions can still creep in. Maybe a stock drops 10% in one day and you panic buy or panic sell without checking if anything fundamental changed. Acting on fear or greed in the name of being contrarian muddies the whole strategy. Emotional trading leads to knee jerk decisions and can turn your portfolio into a seesaw. You might buy in haste when the price tanks, only to find out the company's problems are worse than you realized. Or you might sell early because you're afraid of further drops, missing a rebound that your research originally suggested was coming. Over time, this inconsistency can erode gains and create mental stress. Implement a 24-hour cool down. Whenever a contrarian stock you own or watch experiences a significant price move up or down, commit to waiting 24 hours before taking action. During that period, revisit your original thesis. Why did I believe in this stock? Then, check if new information actually changes that thesis. You can also keep a rational card for each investment listing the 2-3 biggest reasons you bought it. When emotions spike, read your card. If none of those reasons have changed, it might be best to hold your ground. If new facts contradict your rationale, you can calmly adjust your position. Separating your decisions from immediate emotional reactions keeps your strategy consistent. It allows the facts to guide you rather than headlines or panic. In the long run, this approach can yield more stable results and help you remain confident under pressure. Emotions will always be part of investing, but by channeling them through a disciplined process, you give your contrarian bets a better shot at success. Some contrarian investors do exhaustive research once and assume that analysis stays valid forever. They neglect to follow up on quarterly earnings, product launches, or potential red flags. A stock that was undervalued last year might now be fairly priced or even overvalued. If you buy a stock and never look back, you could miss huge changes, new competitors, regulatory shifts, or declining revenue. Your original contrarian thesis might no longer hold, and by the time you realize it, the stock's price might have already plummeted. Or conversely, you might miss an opportunity to sell at a premium if the market becomes overly optimistic. Schedule a quarterly deep dive for each of your contrarian positions. Every 3 months, spend a set amount of time revisiting the company's latest financials and any industry twist. Do a reversible case each time. Pretend you're someone who thinks the stock is now a bad investment. Can you find evidence that supports this negative view? If it's compelling, you may need to reduce or exit your position. Also, keep an eye on valuation drift. If the stock's price to earnings ratio has soared beyond historical norms, while earnings haven't grown that much, it might be time to reconsider. This ensures you don't hold onto a once undervalued stock that's become overheated. By regular reassessing fundamentals, you stay proactive and avoid big unpleasant surprises. You also get a chance to lock in gains if the market becomes too exuberant. This disciplined follow up helps you refine your contrarian approach, ensuring you're always basing decisions on current rather than outdated information. Over time, that vigilance can significantly improve your portfolio's resilience and return.